Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Invite V Vaidyanathan, Executive Chairman of Capital First, to clarify some doubts or some issues on which shareholders will argue with themselves before they do the vote. Mr. Vaidyanathan, thank you very much for joining us. Well, the first question that might occur to a shareholder is that Capital First was retail, 90%. And that gave you a great price. You were at 900 before the merger. After the merger, you're at what, 650 now? So, why are you getting into institutional or wholesale? What would you have to tell them?
I think this was one of the key concerns, shareholders had after we announced the merger. And I think it would be a valid concern because close to about 50,000 crores of infrastructure and wholesale book did exist at IDFC Bank. The fact is that as we progress the story forward over the next few years, we believe that we can build back the retail business from, say, about 30,000 crores on a combined basis of the two institutions, all the way back to about 1 lakh crore over the next 5 years. So this is not a projection, this is not a promise or anything like that, but this is basically a question to address to shareholders as to what is the management thinking. So from that point of view, I'd put that number out. The number two that's coming in my mind is that retail is a proportion of the book, which will probably come down to 30% from 90%, would actually go back to about 65 to 70% over the next 5 years again. So this is what we're thinking. So this is not something that should bother shareholders at all. The number two is that to the extent that the wholesale book exists there in IDFC Bank, I think the management has done a very credible job of cleaning up the books, and whatever residual is there, it just appears that they'll clean it up this quarter.
Mr. Vaidyanathan, good morning. What about competition? I mean, this space has been growing very fast, but growing with some big players that are well entrenched in the market. How do you plan to sort of penetrate the market?
First of all, we are in the lower ticket size of the market. We are not giving 1,000, 2,000 crore loans, which the large corporates have given. Now, as far as the lower ticket size of the market is concerned, we have close to about, say, 6 million customers on our side alone. In fact, 7 million customers as we speak. Now, that's a big diversification. Now, we think that this space is so large that even if more banks enter the space, the SBIs and the large public sector banks, even the private sector banks, this is just so large. And I think, therefore, we should not really worry about who's taking what market share. This is a story of underpenetration. This is a story of financialization. This is a story of democratization of credit. And that's a very, very big story.
Yeah, Mr. Vaidyanathan, good morning. In fact, that was my next question because, invariably you're always compared to Bajaj Finance. And we've seen the kind of stunning growth that Bajaj Finance has shown. And it's a business. I mean, of course, now, we go to Croma and we go to other places. I can see that, that's Capital First along with Bajaj Finance. But in terms of catching up or in terms of garnering some more market share, your thoughts on that?
That is again a very big market in India. Now, it's not just Bajaj Finance, it's not just Capital First. Of late, we're seeing a large number of people entering into the consumer financing market. But that story is expanding not because of the fact that that market is growing. It's also because the amount of ecosystem has dramatically changed in India. You can go to a marketplace, you can meet a customer, you can get access to Aadhaar, you can get access to Credit Bureau, you can get access to a number of databases, you can do deduplication. You can do that instantly. So therefore, with the ecosystem evolving, I don't see any reason why that market, whether for Capital First, for other players, should not grow by anywhere about, let's say, 20% year on year.
Okay. Well, let me come to, once again, the shareholders' thinking, especially IDFC Bank, especially Capital First shareholders. You have bought IDFC Bank banking license. It will give you liabilities at 4%. As Capital First, you are probably borrowing at 7-8%. That would be the natural reason why anybody would want the bank license. But what is IDFC Bank's current account and savings account deposits? It's about 6-7%. So you've not got what you want, liabilities.
First of all, nobody's bought anybody. It's a merger of two institutions.
Okay, sorry. Yeah.
And secondly, this is a very important question because if we say that we've got to grow the retail loan book to 1 lakh crores over the next 5 or 6 years, where is the liabilities going to come from? Now, this is, again, just like we talked to the assets market, liability is a very big market. Let me give you the numbers. The current account market in India is close to 10 lakh crores. The savings account market in India is about 37 lakh crores.
Yes.
So together is 47 lakh crores and growing at about 5% per year. That's a CASA market of India. Now, on 47 lakh crores, can we not get 40,000 crores over the next 5 years? That's all we need to build a good CASA.
None of the other PSU banks got it. It is still with SBI. It is still with HDFC. You know, they've all been in the race for so long. DCB asked Murali Natarajan, he'll tell you, liabilities have not come that easily.
No.
Do you as you said, 7 million asset customers. Is it possible for you to translate them into liability customers?
Many of them will, but that's not the only story. And in fact, that cannot be the only story. Digital cannot be the only story. We need branches. So we will intend to put out, say, 500, 600 branches for sure. And in fact, as the game plays out, even 1,000 branches. So when you put out between 600 to 1,000 branches and you provide payment solutions, it is inconceivable that you will not get CASA, because CASA comes from payments. CASA comes from the ability to allow people to transact seamlessly. On that front, I must say, while IDFC Bank may not have got the numbers on CASA, they have developed an exceptional architecture on how this can be enabled. So basically, they've done all the plumbing work. We just have to scale it up.
But you're talking about 1,000 branches, incrementally, right? 1,000 branches that you're going to add?
Cumulatively. We're
Okay.
talking of 600 to 1,000, actually. It's,
Okay.
let me say first phase right now we're thinking of 600. That's what we planned the P&L for. But I'm not ruling out taking the game up. Now, you might well argue saying that why branches?
Yeah, because, I mean, branchless banking, mobile banking has picked up so much. So don't
Well,
you
if
want
you
to
go
move
to
to
a
that?
large bank in India, let me say 1,000 branches are table stakes. Now, of course, digital is a big story. We talked about how the ecosystem is changing with terms of Aadhaar-enabled payment services and mobile and Jan Dhan and all that. That is definitely changing. The ecosystem is changing. But that can't be the only game. So it's basically both the physical branch network of, let me say, 600 to 1,000 branches and a digital architecture. We believe together it's necessary. It's not the digital alone.
The last results of IDFC Bank were not flattering. They did well more because of a one-time gain, some 81 crore. So will there be cost cuts? If you're not going to concentrate on wholesale, will there be, while there will be hiring of one kind, will there be firing of another kind?
Actually, the way we should look at this is not about a quarter's result, about what the core profit of IDFC Bank is or what Capital First is. First of all, Capital First itself is carrying close to a quarterly run rate of 100 crores a year of core profits into the institution. As far as IDFC Bank is concerned, there we have to see when we put them together, what is the going opportunity? And that opportunity is not coming from this 80 or 100 crores that they posted last quarter. It is coming from the fact that our liabilities will get repriced. We are borrowing anywhere between 8.5 to 9% incrementally. Cost of funds of a bank is much lesser, let me say about 7.3% as per their own records of the last quarter. Now, that's a significant saving. Number two, the lending yield of the combined institution today can go up by close to about 200 basis points over the next 5 years, because the fact that Capital First yield is close to about 16 to 17%. So that brings a game. So when you increase the yield, you reduce the cost, then margin will go up. So we should not worry about what this quarter's profit are. We should worry about what the profits will be, say, 4 quarters from now, 16 quarters from now, and say 20 quarters from now. And that story will look really very, very good.
Will there be a lot of cost cutting that you're going to implement?
See, for us to improve the cost, let me say core profit, yes, cost is going to be an important factor. But what kind of costs? Is it people? That's not what we're thinking. Okay. Let me just say that most employees at the operating level management should feel absolutely comfortable, because we believe that's not the storyline here. The story is not cost cuts. The story is synergies. The story is leveraging. Okay. Leveraging on their balance sheet, leveraging on their branch network, and for them to leverage on our kind of unique model that we built over the years.
Okay, actually, let me come to ROE. That ultimately, that's what your investors will want. Your ROE, that is Capital First, was 16%. Now, after the merger, I don't know what it comes down to, I guess low single digits. What can you promise by way of ROE and by when?
Let me tell you what we estimate the profits for the first year as a takeoff year to be. And I caveat this by saying that these are estimates and these are management estimates, and these are not really guidances. But Let me just say that our estimates for the first year are about 600 crores of profit. I believe that's a pretty good number to start a game with. Return on equity will come down from, say, 16% to probably, say, 4%. But I'm pretty confident as the branches roll out and as the merger strategy plays out, this 4 can continuously grow to 6, 8, 10, 12, 14, 16. We believe such a story is playable over the years. And I believe at some stage, you started the story by talking about investors' concern. We've seen the story play out at Capital First before. When our return on equity moved from, say, 0% to 8% on a stable basis, the market re-rated us from 1-time book to 3-times book. I believe at some stage, market will recognize the story.
All right, Mr. Vaidyanathan, thanks a lot for joining us.
We wish you all the very best
Exactly.
for that kind of a re-rating and
Yes.
that kind of a scaling up.
Yes,
and